In the world of investments, real estate investment trusts, REITs, are quite the topic of discussion, and for good reason. Right now, we're seeing many REITs trading at notably lower prices, but as with anything in the financial world, there are exceptions. Big shout out to Seeking Alpha for sponsoring our video, and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. In this context, let's focus on 5 REITs that we would advise you to approach with caution. REITs, often represented by ETFs like VNQ, are in an intriguing spot currently. They present an uncommon chance to invest in solid companies at reduced prices. Moreover, various studies have revealed that REITs have a tendency to shine when interest rates are high. They tend to deliver returns that are about twice as much as regular stocks, as represented by popular benchmarks like SPY during the 12 months following the peak of interest rates. Here's our reasoning. We think the Federal Reserve, the Fed, is nearing the end of its cycle of increasing interest rates. Our belief stems from the fact that inflation has already dropped to approximately 3%. Using up-to-the-minute data on inflation related to housing, we've estimated that inflation is currently significantly below the Fed's target of 2%. Simultaneously, we're witnessing an unusual development in the yield curve. It's currently more inverted than it's been since 1981. In simple terms, this means the bond market is predicting that the US is heading toward a recession in the near future. Historically, the bond market's predictions have proven to be quite accurate. If indeed we do enter into a recession, the Fed will likely respond by reducing interest rates, as it has done consistently in recent history. This, in turn, could trigger a surge in REIT prices. However, you might be wondering if this time things will be different. Will interest rates and inflation remain at higher levels for an extended period? We're skeptical about that, but even if that scenario unfolds, it's reassuring to know that REITs have a track record of performing well during times of high inflation. So, while REITs may look enticing now, it's prudent to remember that not all of them are created equal. Consider your investment choices carefully, particularly in the ever-changing financial landscape. Should investors be on a shopping spree, scooping up assets after the recent market correction? Well, we think it's a good time to consider it. But, and this is a big but, one has to tread carefully because risks are riding high at this point. The real estate scene is undergoing a bit of a roller coaster ride. Many office buildings are grappling to stay afloat. Some over-leveraged real estate investment trusts, REITs, are slashing dividends, and refinancing debt is becoming trickier. So it's not just about buying, it's about choosing wisely. In fact, in today's financial terrain, the importance of picking the right REITs can't be overstated. We're not saying to avoid all REITs, but there are certainly some to be cautious about. Let's zero in on 5 REITs that, in our opinion, might not be the best picks. Tanger Factory Outlet Center, SKT. Tanger holds the title for being the largest owner of outlet centers in the US. It boasts 37 centers, and its tenant list reads like a fashionista's dream, featuring brands like Nike, The Gap, and Under Armour. At first glance, it seems like a success story, as Tanger's stock defied gravity when many others took a nosedive. It soared by 24% since the start of 2022, while the broader REIT index, VNQ, tanked 34%, and its peer, Simon Property Group, SPG, fell by 31%. But before you rush to invest, let's mull over some factors. Tanger operates in an industry that's not on the growth track and might even be on the road to a decline. Why? Because outlet malls are at risk of losing their appeal to e-commerce. Think about it. The primary allure of driving 45 minutes to an outlet center instead of heading to your local mall is getting lower prices. But the thing is, not even outlet malls can beat e-commerce when it comes to pricing. The stores at Tanger's centers have been witnessing a slide in sales per square foot, adjusted for inflation, for quite some time, and there's no sign this trend is about to make a U-turn. It's not just Amazon. Now, discount retailers like TJ Maxx are popping up all over, typically in more convenient locations. Tanger managed to deliver impressive double-digit rent spreads in the last 2 quarters, which largely propped up the stock. But here's the catch. Over the next 2.5 years, 53% of leases are set to expire. This, coupled with a potential economic downturn and a slowdown in consumer spending, might make renewing these leases or finding new tenants at reasonable rents a real challenge. To top it off, the stock looks expensive, trading at 13 times funds from operations, FFO, especially when compared to SPG, which trades at a mere 9 times FFO and flaunts a much more secure A-rated balance sheet, while SKT holds a BBB rating. So, all things considered, it might be best to take a step back from SKT for now and consider investments in companies that are either undervalued compared to their peers or, at the very least, are operating in a sector with growth potential. Remember, thorough research is your best friend in the world of investments. So here we have Brandywine Realty Trust, an office-oriented real estate investment trust, REIT, with a pretty heavy focus on the Philadelphia market, plus a minor 20% exposure to Austin, Texas. Office spaces have taken quite a hit recently. We're talking about the perfect storm of high interest rates, the looming threat of a recession, the ongoing work-from-home shift, and the headaches involved in refinancing debt. All in all, it's a pretty risky business. Brandywine has been making a lot of noise about its life science-focused approach and even shouted about ambitious plans to expand in this field. But here's the kicker. Life sciences currently make up less than 5% of its portfolio, so it's a bit of a stretch to say they're well prepared for the work-from-home trend. To make things even more complicated, the majority of Brandywine's properties can be called traditional office spaces, typically leased to companies in financial, legal, and business services. These sectors are among the ones that will likely struggle the most in the current environment. So, yeah, BDN might find it tough to keep those tenants. In fact, the last 3 quarters have seen negative net absorption, which is a fancy way of saying more space has been vacated than leased. Although they managed to keep their occupancy steady in Q2 2023, expecting a magical turnaround to increase occupancy would be a bit optimistic, especially when you consider some of their properties on the outskirts of Philadelphia are as empty as 50%, which means they need some serious cash, capex, and sweet deals, higher tenant incentives, to fill those spaces. All of this is bound to put a dent in the company's cash flow. As a result of these struggles, BDN stock has tanked by a whopping 69% since the Fed started cranking up interest rates in early 2022. The silver lining for investors is the dividend yield, which has skyrocketed to over 15%. But here's the twist. The market doesn't seem to think the company can keep paying such a high dividend. It's essentially pricing in an imminent dividend cut, and we're inclined to agree with that market sentiment. Despite a 70% payout ratio, meaning they pay out 70% of their earnings as dividends, it seems pretty likely the dividend will be slashed as cash flow shrinks due to their efforts to increase occupancy. With all of these challenges in the mix, there are probably other investment opportunities out there with a better risk-to-reward ratio. Granite Point Mortgage Trust, GPMT. Now let's talk about Granite Point. It's a mortgage REIT, which falls into the category of MREITs. Before we dive into this particular company, it's important to note that MREITs as a group have had a pretty rough run. They've been sort of like value traps, returning an average of just 1.9% annually over the past 20 years. That doesn't necessarily mean all mortgage REITs are doomed, but there are certainly sectors that have a history of outperforming MREITs. So, what makes Granite Point stand out as a risky bet? Firstly, more than 40% of their $3.6 billion loan book is tied to office loans. Given the current state of office spaces, that's not exactly comforting. On top of that, the company has a high leverage rate of 2.7x. In simple terms, it means that if there are defaults, shareholders could see losses that are significantly multiplied. Now, the scary part. They've already experienced a pretty significant default in Q4 2022, which resulted in a hefty loss of $15.5 million. Adding to the uncertainty, they have several office loans with a 4 or 5 rating, which basically means they're at high risk of defaulting soon. Finally, their payout ratio has been sitting well above 200% for the past 4 quarters. That's not really a sustainable situation and is a red flag for investors. So, given these circumstances, investors might want to think twice before jumping into an REIT like Granite Point and consider sectors with a more favorable track record. Investing is a bit like surfing. Sometimes you need to wait for the right wave. Granite Point seems to be playing with fire on 2 fronts. Firstly, their dividend doesn't look very sustainable with such a high payout ratio. And secondly, office loans aren't the safest bet right now, as defaults could spell major trouble. Given these straightforward reasons, it might be wise to steer clear of GPMT for the time being. Easterly Government Properties, DEA. Easterly Government Properties is a unique player in the REIT world. They specialize in owning and leasing properties to various agencies of the US government. This might sound like a pretty secure setup. After all, the entire revenue of DEA is backed by the full faith and credit of the United States government. But there's a catch. The issue is, this isn't a growth business model. Many of these buildings are built to suit, meaning they're custom-made for the government's specific needs. As leases expire, the government has a lot of bargaining power to keep rent as is or even ask the REIT to cover tenant improvement costs. Because finding new tenants for such specialized spaces is almost impossible, DEA is forced to give up on growth. As a result, the funds from operations, FFO per share, has been stagnant since 2016. This has translated to subpar total returns for investors, hovering around 5–7%, primarily from dividends. The future doesn't seem very promising either, as there's little reason to believe FFO per share will see significant growth. To make matters worse, the quarterly dividend of $0.265 is barely covered by the core FFO per share of 29 cents. If you throw in maintenance capex, which you should, the payout ratio is already above 100%. This could set the stage for a dividend cut, which would be particularly painful for an investment that has mainly relied on dividends for its total return over the past 7 years. All things considered, DEA might not be the best choice in the current market. It's simply not positioned for strong growth, and the risk of a dividend cut looms large. LTC Properties, LTC. LTC Properties is a healthcare REIT specializing in assisted living and skilled nursing facilities across the U.S. It's sort of a mix between an equity REIT and a mortgage REIT. About 2/3 of its revenue comes from rent, while the rest is from interest on outstanding loans. Now, the healthcare sector has been through the ringer lately. COVID-19 threw a massive curveball at the industry. Occupancy rates have been pretty low, with skilled nursing occupancy hovering around 70%, and assisted living doing only slightly better at 80%. LTC has another problem. They are highly concentrated on just a few major tenants. Prestige Healthcare takes the top spot, accounting for 14% of total rent, followed by ALG Senior at 10.5% and Brookdale Senior Living at 9%. This wouldn't be such a big issue if these were large, rock-solid companies, but in many cases they're relatively small, privately held ones operating just a few dozen properties. To make things even riskier, the average rent coverage by these operators is less than 1.5 times. When you put all this together, it doesn't look like management has the magic wand to turn things around. The stock has been an underperformer, dishing out just 4% annual returns over the past 10 years. What's more, the payout ratio is starting to stretch at 89%, which could threaten the 6.8% dividend. Similar to DEA, a dividend cut would be disastrous for LTC Properties, which has leaned heavily on its dividend for positive returns over the past decade. With so many tempting investment opportunities in the current market, there's just not much of a reason to dive into LTC Properties right now. Bottom line, out of these 5 REITs, the ones to avoid are pretty clear. They're dealing with shrinking cash flows, have poor growth prospects, and some of them even have valuations that might be getting ahead of themselves. But remember, these are exceptions. The overall REIT landscape currently presents a rare opportunity, with the key being to sift out the strong contenders from the weak. Be selective, and you can find some real gems in the REIT market today.